Once you start doing physical work on the property, and these are physical assets like real property, I'm physically improving the value, the IRS is gonna say that's increasing the value and the IRA is not properly paying for it. And we think that's where you're gonna have a prohibited transaction issue.
Why is that okay? Well, because your mom's gonna give you a sweetheart deal. Your aunt always hated you. So the IRS is gonna bank on that. So there's anybody that's on this disqualified list, they're gonna give you a deal and screw the IRS.
We are here to talk about what you can and cannot do with the self-directed IRA.
This is part 2 in our 10-part series. If we can eat 10 parts out of this, I think we will. But if you're just joining us for part 2, please go back and listen to part 1. Part 1 was, what is an IRA? What can I invest in? We gave some really creative examples and gave you the bounds of what you can invest in. Now we're going to eat the frog. It's part 2. We're going to talk about the rules to playing the game.
Yeah, the nice thing is there's not a lot of restrictions. I think a lot of people, when they think of IRAs and they're used to buying a stock or a mutual fund, then they're like, wait, I can buy real estate? I can invest in a small business? I can invest in a private fund or crypto? They're like, there's got to be a lot of rules about what you can and can't do, and surely you can't do this stuff.
Oh, you mean your stockbroker wasn't correct when they said there's all these rules, watch out, you're going to go to hell? Or Jim Cramer on Mad Money saying that the last thing you want to do is self-direct because you'll lose everything? It's really not that bad?
It's not that bad. Okay. Now, we are 2 tax lawyers. I wrote the #1 book on the subject of what you can and can't do. Government regulators buy my book. And so we know what we're talking about here.
I don't know if I brag about that.
Yeah. Well, they need to learn this stuff too. I'm teaching them is what I'm trying to tell you. All right. Okay. So, but the nice thing is there's not a lot of restrictions, but there are some really important rules you do need to know on the other hand. So let me hit the things you cannot buy with an IRA. This is the first thing. What can I not buy with an IRA? This is in the tax code in section 408. The first thing you can't buy is collectible items, okay? Collectible items are restricted as an asset for your IRA. When retirement accounts first came out, you could actually buy like art. You could buy a collectible car. The problem was there was a lot of abuse happening, and so Congress later came back and said, you know what, for your retirement account, 401k, IRA, you actually can't buy a collectible.
And let me add that we gave some fun examples in part 1 again. And number 2, let's go to the S Corp, because the S Corporation is built for you entrepreneurs out there as an operational business. They're built for the small business on Main Street America. S Corps are not built to be owned by an IRA, and hence your IRA cannot open an S Corporation. Now, we're going to talk about your IRA or 401k, these self-directed retirement accounts can do business, but it's going to be in a different format. And we're going to teach that in some other sections here. But you cannot buy an S Corp. You cannot buy collectibles. Is there anything else?
You can't buy life insurance with an IRA. Not that you were coming to learn how to buy life insurance with your IRA, but that's it. So, okay, so let's just take those off the table. Collectibles, S Corporation stock, and life insurance. That's it. Everything else that is an investment asset qualifies, and I want to make sure everyone understands that. We're not talking about buying personal assets you're going to have use of. So when we say you can buy real estate, we're not talking about buying real estate that you live in. We're talking about buying real estate for investment purposes.
Yes, and now it's not so much about what you buy. It really is about how you buy.
And who.
Who
is involved here? For example, if I'm buying real estate.
First rule then.
Yeah.
Let's do who first? Is that what you want to do?
Let's do who first.
Okay.
Because that's really what it all comes down to, is the who.
It's who you know. It really does. It's who you know.
And you know who you shouldn't be doing business with, okay? Because this is called the prohibited transaction rule. This is 4 chapters in my book, but it's not that complicated. The basic principle is when your IRA is buying, let's say, real estate, the IRS wants to know who's selling that real estate to your IRA. Who's renting that property when you turn it into a rental? Who's the contractor doing the rehab? And essentially what the IRS has said, and Congress, as they wrote this prohibited transaction rule, is we don't want your IRA transacting with someone who is considered a disqualified person. And we're going to go through that list on what is a disqualified person. But that includes you, by the way. So for example, you can't sell real estate that you currently own personally to your IRA.
And I want to add another perspective again. We talked about what you can invest with. So let's just sticking with that. If I'm going to do an investment from my retirement account, how do I acquire it? Who can I acquire it from? There's going to be a lot of how-tos on the transactional piece in our 10-part series. But let's just talk about who can I buy that investment from? And I like that you point out, first, you cannot buy from yourself. And give us a list. Who are these disqualified people that are so bad?
Yeah, yes. Pretty much it's who the IRS doesn't trust you doing deals with, okay?
Yourself.
Yeah, so they start with yourself, okay? They also include your spouse, okay? And for those of you in Utah, this is all of your spouses, okay?
Oh my gosh, that
we
was
gotta
good.
count all of them.
That was
Yeah.
good. I've never heard that joke.
Okay, yeah. That's one of my regular jokes, by the
Yeah,
way.
well,
So
yeah.
Mark's heard it 100
Sister
times.
wives. I mean, it's a good one. I like it. I use it too.
Then your parents are also on the list of disqualified persons. Your grandparents are on the list. Your kids, spouses of your kids, okay? These are all disqualified people. So for example, we'll have sometimes clients call up and say, hey, I want to buy this rental property. My kid's going to college. I'm going to buy a rental in the college town and my kid's going to live in it. Well, you can't do that either because now your kid's a tenant who would be paying rent to your IRA and your child is a disqualified person to your IRA.
Now, Matt brought up the contractor that's going to work on this rental. We'll come back to that. That's after acquisition. So if we're sticking with acquisition, you say, okay, I can't buy from my mom or dad, but I really want this rental, but my mom only owns 40% of it. The other 60% is someone else. Okay, now this is where we get into the weeds a little bit more. You say, okay, I can't buy from my mom or dad, but they're not the majority owner.
Yeah.
Okay, now we may have an option.
Yes.
And this is where it kind of goes from really dark gray, like, oh, they're only a 49% owner, to maybe they're only a 10% owner. And we get, gosh, there's a movie about this. What do we call this?
Yeah.
Oh.
50 Shades of Grey.
Oh, yes,
Yeah.
that's it. Yeah. So we want to be a little closer to the lighter gray, not the dark gray in this example.
Yeah. So in other words, let me say it another way is, let's say, then this happens a lot. You know, let's say your mom owns 40% of a property and her sister, who is your aunt, owns the other 60%. Okay, maybe they inherited this from their parents, whatever it may be. Okay. And you're like, all right, well, I'm going to buy that with my IRA as a rental property. The question is, who are you buying the property from? Okay, we got aunt 60%, let's say, for example, and your mom who owns 40%. Now, conceptually here, you are under what's called the 50% rule. There's a rule that says if disqualified people, your mom is the only one in the example here, your aunt's not a disqualified person, but if disqualified people own 50% or more of the deal, then your IRA cannot transact with them. But here, conceptually, your mom is 40%. She's not in control. Your IRA could buy the property here.
Okay, now I want to throw out the factor. Well, maybe it's an LLC. We'll come to that. But now, let's just ask why for a minute. Why is that okay? Well, because your mom's going to give you a sweetheart deal. Your aunt always hated you. So the IRS is going to bank on that. So they're saying anybody that's on this disqualified list, they're going to give you a deal and screw the IRS. So that's what they want. It's just kind of this self administering kind of protection by saying anybody that's non-disqualified, if they have majority control, knock yourself out. We know that they're not going to give you a killer deal. That would not make sense.
Yeah.
Okay, but Matt.
And can I give another example to highlight it one more time? Because this is this 50% rule. And a lot of times it comes up with LLCs. So let's say that you own 1/3 of an LLC, two other investors each own 1/3, and there's 3 of you total in an LLC. You bought a property, you rehabbed it, you're ready to sell it and flip it. And let's say that you're like, well, I want to buy that for my IRA actually. I own 1/3 personally of the LLC that owns the property, and the other 2 owners are not related to me. They're just other investors, cool people. But I'm like, I want to buy and hold this as a rental with my IRA. Could I do that? Yes, you could, okay? Because you only own 1/3. All right, you're below this 50%. So now my IRA could transact with the LLC, but let's change the facts. Let's say that you own 1/3, your spouse owns 1/3, and some third party owns 1/3. Can my IRA buy from the LLC? No, it can't, because I got to add up all of disqualified people, me at 1/3, my spouse at 1/3. Now we're over 50% because we're at 66 here. Now that LLC, the IRS looks at that and says, well, you've got too many people. They're in control. They own 50% or more who are on the disqualified list, so your IRA cannot transact with that entity.
Yeah. And I like that we've got the LLC on the table too, because some people go, well, okay, my mom and aunt own this property, but really they have it in an LLC. So my IRA can just buy it from this LLC. Nope. You have to look at the underlying ownership, whether it's you, your wife, and a third party, or you and 2 partners, or your mom or aunt. LLCs do not give you a carte blanche ability to hide it. You have to look at the underlying ownership. Now, I want to just digress and say this too. Let's take a breath. Some of you are like, oh my gosh, this is already more rules than I wanted. This isn't that bad. We just got to talk about who you're going to buy from, and we're going to finish this. But I want to say this too. When you work with our law firm and Directed IRA, we have created this synergy over the last 25 years of our law firm knowing these rules. And now with Directed IRA, we make it even more seamless, where you'll get a consultation with the lawyer. You can explain your deal. They will help coordinate the funding of the LLC with Directed IRA. You're going to go into this with all the answers you need if you choose to work with us. I just want to let you know that we have an escape hatch here where you can go, okay, I get the rules generally, but who's going to really walk me through this and stand behind it?
Yeah.
So it's very affordable in the big scheme of things by far to have the law firm prep the LLC. It's not your typical LegalZoom LLC. We're going to have a whole section on LLCs in this 10-part series. Yeah. But I just want to, right when we get into rules, I want to let you know we've got a referee for you. We've got a lawyer that's going to help you play the game on the field and not get in trouble.
Yeah, there's a strategy called an IRA LLC or checkbook IRA. We're going to have a separate section on here. But what I would say at this point is if you're doing a deal with family members and you're like got some creative structuring going on, that's where you're going to need a consult with a professional that understands these rules. And that's what our law firm has been doing for years. And we can help you there. We got that service. All right. But if you're like just buying from some third party and you're leasing to some third party, the rules are pretty easy. It's not that complicated. I mean, I wrote a book on this thing, but what I'll say is it's kind of like, this is like playing a board game, all right? It's not that complicated. Once you do it a few times, it's the same thing over and over. But if you want to get creative and kind of tinker with the rules a little bit, that is where you do need some competent tax and legal advice.
Okay, now let's go back to the big rule today in today's podcast. The IRS says you can self-direct. Here's the assets you can or cannot buy, but you cannot personally transact, or you cannot transact with your IRA in a disqualified way. Okay, what does transact mean? It can mean a lot of things, like rehabbing property, using the property, renting the property, buying product, getting a real estate commission. We're going to go through some of that. But the first transact is just acquiring the investment. So that's what we just talked about. When you go out to acquire an investment inside that retirement account, you're going to say, okay, here's the list of disqualified people. If anybody in combination own more than 50% of what I'm trying to buy, LLC, trust, who cares, whatever the hell it is, I'm going to have a problem. So you're going to want to bring that up with your lawyer and go, okay, I want to find a way around this. Is there a way? Sometimes there is. But the general rule is we want to be careful about ever trying to buy something from disqualified parties that have in conjunction more than 50%. Now we own the property. Okay. What other transactions could occur?
Yeah, let's say you're going to do a rehab. Well, actually, before we even get to the rehab, who was the realtor?
Oh, yeah, good. I dropped that in there. You saw that. Huh?
Who was the realtor on the buy? We have a lot of real estate investor clients who happen to have a real estate license, all right? And they're like, can I get the 3% buyer's agent commission on this deal? No, you cannot. Now, let's think about this, because a lot of people think, but Matt, I'm not transacting with myself. The seller is paying me that commission. My IRA is not paying that commission to me. This is coming through closing, and really it's coming from the seller's proceeds. They're offering that 3% to anyone that buys. So how am I transacting with myself? Well, this is where you need to know another rule, which is called the self-dealing prohibited transaction rule. If a disqualified person financially benefits because your IRA makes a transaction, then that also causes what's called a self-dealing prohibited transaction. So the commission is the easy one where my IRA bought it, and because my IRA bought it, I got to make a 3% commission on the purchase price, okay? So basically, really what I would just say here is a disqualified person should not get the commission. Now, I'm okay with you being the agent on this. Just waive the commission. You don't need to go hire a third party to serve as your agent. Just waive the commission so you're not personally making money and reduce the purchase price by 3%, which really is your IRA benefiting. But that's okay. Your IRA can benefit in that scenario.
Now let's get to the contractor.
Yeah.
So let's play with that for a minute. So you buy the property from a proper party, you waive the commission, no extra benefit for you there. Now you're into the rehab and you're like, okay, Mark, I'm going to go work on it. Whoa. Okay. Now you're benefiting the IRA with your services, and it's almost like you're adding a contribution to your IRA that's not allowed. You only get $7,000 a year. But by doing personal services instead of hiring a contractor, I'm really adding value to my IRA over and above what I'm allowed to do.
Yeah.
And so you're like, I'm not benefiting. I'm working my ass off here.
Yeah.
You know, well, your IRA is benefiting from these services, and that's not allowed. It would be prohibited. So you've got to hire a contractor. Okay, well, I'll hire a corporation, a construction company that I own. No,
Same
the
issue.
underlying ownership again. So you've got to hire third-party contractors. Is the solution there? Now that's my take on it. How would you say it?
Yeah,
You could say it different ways.
You're thinking about once you buy an asset from your IRA, what can I do on the asset? How do I manage this? Well, the IRS is good with you doing management and administrative oversight tasks. I go to the property and check on it. I tell a contractor what to do. I do the paperwork. I determine who to lease it to, who to sell it to, what to buy. All those are fine. That's managing and administrating your investment in your IRA. That's okay. But once you start doing physical work on the property, and these are physical assets like real property, I'm physically improving the value, the IRS is going to say, that's increasing the value and the IRA is not properly paying for it. And we think that's where you're going to have a prohibited transaction issue. And so if the IRA paid you for that, of course, that was just a transaction because you got a check from your IRA essentially, so that's not okay. But also if you do that physical work on the property and don't take a payment, we worry that that would also constitute a prohibited transaction because you're providing that services. So if you stick to the administrative management stuff, paperwork, decision making, who to rent to, who to sell to, who to buy for, that's okay. But once you start crossing over to physical improvements, improving the value of a physical asset like real property, we worry you're going to have a prohibited transaction.
And if we could only say that's the end of the show. But that also goes for your disqualified parties.
Yes.
So your spouse cannot go work on it. The mom and dad can't work on it. The kids can't work on it in this transactional piece. So you acquire the property. Now you're fixing it up. You and disqualified parties cannot work on it. Now, I know what you're going to ask. Well, Mark, okay, I'll pay my son fair market value to work on it. He's not doing it for free. Yeah. I mean, I will literally pay him even more than what a contractor would want. That could be an abuse perspective too.
Yeah.
No, they can't work on it whether you pay them or not. No disqualified parties can work on it for compensation or not. Just the oversight administrative things that Matt just said. Now, maybe we go to use for a minute. So I buy it. I fix it up. Oh, and it's the cutest little short-term rental. It's adorable. And it's making money in my IRA, tax-free, tax-deferred, whatever, 401k, Roth, whatever. I'm just killing it with this little short-term rental. Well, I can go stay there, can't I? I'll pay rent like everybody else.
Yeah. And no one's booked it for this week. You know, why don't I just use it?
That would make sense. The IRS code makes sense.
Yeah. Well, there's a rule for this, okay? You cannot have use or benefit of the assets that your IRA owns. Okay, this gets into this self-dealing prohibited transaction. So if any disqualified person, you, your spouse, your kids, is having use or benefit of the asset, staying there, then it becomes a prohibited transaction as well.
Now, I want to step back to here and to some of you are like, all right, this whole thing sucks. You guys bait and switch. You make self-directing sound so great, and then you tell me all these rules. Screw it. Okay, whoa. All we're telling you is let your IRA go make a lot more money than a stock, bond, or mutual fund. But as soon as you start to think, oh, I can game this, I can use it, I can work on it, stop.
Yeah.
That's the line we're just saying. No, we're not saying your IRA can't go out there and kill it. I looked at my IRA this morning, my Roth IRA, by the way, XRP. Unbelievable. Great day. I also have an IRA that owns some real estate. I'm like, oh my gosh, the market's going up in that area. So I can make money in my sleep in my IRA better than I would ever make in the stock market. Just stop when you start to think you're going to benefit from it personally or benefit your mom, your dad, or I'm going to let my kid go to college and live in my IRA rental. No, that's where the line is.
Yeah, and Mark was really just illustrating the spirit of the law, okay? All right. The spirit of the law here in this prohibited transaction rule is don't try to get all this personal benefit and use out of it. Buy stuff in your IRA and have it invest to make money in your IRA, okay? Not to have personal use or benefit or let my kids stay there or let me help out my construction company or don't do that. Now, most people, frankly, that come to this strategy aren't thinking of that, but
it would be a temptation.
It is a temptation for some, okay? Some can't help themselves. Yeah. They are the real estate agent. They are a contractor. They wanted their kid to stay here for college, and this is where these rules become important. So what I would say is, if you're just out there to go make great investments and you're going to go get the best price possible, buy the best property, You're not going to try to, get in the mix personally with the commission or working on the property. You're going to be fine. Yeah. And that's me. The first property I bought, right? It's like, it's in Indianapolis. I'm not staying there. No offense to anyone in Indianapolis. That's not a destination for me. Okay.
Oh, okay. You were thinking the other day, Cabo or Indianapolis?
Exactly. And I went Cabo for my personal stay. Okay. Crazy. But why'd I buy in Indianapolis? Because it was a great cash flowing market that I thought had some appreciation potential. Turned out to be right. Okay, I wasn't buying it to go stay at or have use of it or stay there in the summers or anything like that. So if you approach it that way, you're not going to need to worry about these rules.
Okay, I've got another spirit of the law. Because see, guys, once you own and get sold on the spirit of the law, it makes all this easier.
Yeah.
Because then you're not fighting against, they say it in scriptural, kicking against the pricks. You're not, I know that sounds weird, but it's a concept of you're sitting on a horse and you're kicking against the horse and you're making it worse. And it's just this concept of, once you understand the rules, it makes operating so much easier and the spirit of those rules. So here's another one. Some people, our naysayers out there, will say, well, that just proves it. You should never buy rental property in your own IRA. You want depreciation. You want to be able to access it. You want that flow through loss. Hell, you might even be a real estate professional someday. So it is stupid to ever buy rental in an IRA because you've got these rules and you don't get the personal benefit. No, we're saying do both. Do both. If your IRA can buy rentals and get a 10, 20, 30% ROI when you add in cash flow and appreciation and all that, and your IRA gets the depreciation if it needs it, that's a whole other concept we're going to talk about in later episodes, but let your IRA just make the most money you can. If it's in real estate, great. Then you go over with your own LLC and still buy that short-term rental. Buy the long-term rental your kids are going to go live in while they go to college. Go do all that real estate and work your little buns off with your Home Depot card. I love it. Do both. It's not that one or the other is good or bad.
Yeah, and as we're talking about the rules here, Mark's trying to talk about some tax rules and some things that people say, don't buy real estate in your IRA because you don't get depreciation. Your IRA doesn't pay tax when you sell a property. There's no capital gains tax. If you do this in a Roth IRA, it's coming out totally tax-free. Your IRA can actually take depreciation on a real estate, but there's nowhere to take it because it doesn't pay income tax. So there's nowhere to put the depreciation. So do you want to live in a world where you don't pay tax on the income, or do you want to live in a world where you pay tax on the income, but you can use depreciation sometimes to offset the losses?
I want both.
Okay.
And you can.
And you can. And that's what we do. We buy real estate outside of IRA. We buy real estate in our IRA. Most of our clients who use an IRA do that. So your IRA, think of it as a long-term wealth building strategy. And how do I get the best return on it? So I'm going to have the biggest retirement account possible. Now, we've talked a lot about real estate. But we could be talking about buying and investing in a private fund, a private company, a small business, crypto. Real estate's just the tangible thing most people understand.
Yeah, it makes sense. And so, it really exemplifies these rules. But I'm actually thinking here, I mean, I got to know who I can buy from, who can work on the property or improve it or manage it. Let's go to managing, because I kind of like that point, and then using it. But let's go back to managing. We really didn't talk about it. Let's try to do something that's not real estate. Okay, in our first episode, Matt talked about a client that bought Buffalo Wild Wings franchise in their IRA. Killer deal. Total home run.
Around about 30% in that example.
Yeah, and so and it's not always about home runs, base hits. That's a whole other concept. But he bought a Buffalo Wild Wings, okay? Now, let's say he owns 70% of that Buffalo Wild Wings. Could he go in and manage the location? Could he go in and be the CFO or the CEO? Could he even be the janitor at night if he wanted to with his kids? No, because he owns 70% or more. But I like Matt, if you just heard it subtly, he said, well, he only owned 30% of those Buffalo Wild Wings. Okay, that means the IRS says, we've got 70% of check and balance here. Because if he wants to go be the janitor, these 70% owners, they're not going to overpay him for that. If he wants to be a manager, great. We're going to pay him whatever the hell we'd pay any manager. You want to do that? Knock yourself out. And so that Buffalo Wild Wings is now about management. Yeah. It's not about rehab.
Yeah, and we see that with a lot of clients who invest their IRAs in a small business or a startup. The question we'll get is, well, can I work in the company? Well, we're like, well, how much do you own already personally? How much does your IRA, is it going to own? And any other disqualified people. So if you're like, well, and we get this all the time, and there's cases on this even in my book too. They're like, well, I only own 5%, or I'm going to buy another 5% with my IRA. don't worry about it. Go work in the business, get a salary, help grow it, and build
buy
it.
both chunks.
Yeah. But if you're like, well, I own 100% of this already and I want to sell some to my IRA, not going to work from the get-go. Or if you're like, I'm starting a new business and my IRA is going to own it 100% or even 50% or more, or you and your IRA and combined with disqualified people are going to exceed this 50%, it's just not going to work. Now, in the example I gave of the Buffalo Wild Wings, this client's IRA, just to understand that example, was just putting in money to own 30%. The guy had zero interest in working for it. His IRA was just the cash investor. But you do see people sometimes who are like, well, I want to have my IRA come throw some cash in, and maybe I am working in this business. And that's possible if disqualified people, including your IRA, are below 50%.
So good. So with that in mind, you really have now understood the spirit of the law, the reason behind the law, and this list of disqualified parties. We talked about acquisition, rehab, management, and use.
I got one other
that's what I was saying.
example.
I was thinking if there was one
There's
more
only
issue.
there's one thing left I at least want to hit, which is the extension of credit privilege.
Oh,
transaction.
yeah. Good call.
So let's say, and let's go back to real estate again, simple. Let's say you wanted to buy real estate with your IRA, but you didn't have enough cash in the IRA to buy the real estate. Let's say the property was $300,000 and you had $100K or $150K, let's say, in your IRA. So you couldn't buy it outright. Well, could I still acquire that and get a mortgage? Yes, you can. But you can't go get a regular mortgage where you're going to personally guarantee the loan. They're going to run your credit, come after you personally if the IRA defaults. But you can get something called a non-recourse loan. There's probably 10 banks that play in this space. If you go to directedira.com, we have a list of these banks, and they will lend you money, a mortgage, to buy real estate with your IRA, where if you had 150K in your IRA, they'll let you buy a 300K property, and they will lend the balance. Now, these loans, a lot of real estate investors are familiar with how they would qualify. It's called a debt service coverage ratio loan, DSCR loan. They're basically going to look at the property and say, hey, is the cash flow you expect to get on that rental enough to cover the mortgage payments? And as long as it is, they lend the property. But it's non-recourse because if the IRA defaults, what happens is the bank is going to foreclose and take the property back. That's it. They don't come after you or the IRA for any deficiency. So that qualifies under IRA rules. If you guarantee the loan, though, the IRS says you personally, as a disqualified person, extended credit to your IRA, and this causes what's called the extension of credit prohibited transaction.
I love it. Okay, now I want to just give you a little sneak preview. With all this said, there's a special rule that allows you to go out and do a new deal with your IRA. So we just said you can't go sell your current business to your IRA. You can't. Your mom can't. Your kids can't. But let's say you and a family member and your IRA, your brother's IRA, your mom's IRA, your kid's IRA, all want to pool their money together and go buy a business. You can do that from someone else. So pooling your money is okay. Transacting with these other parties, IRAs, is not okay. That would be an exception, which we're going to talk about in another episode. So if I've wet your whistle at all, you've got so much to learn, so exciting, because you are unlocking a whole other world here of return on investment, ROI, what you can do with your retirement account. It is so exciting. So I think you've eaten the frog. You've done the work to understand what these parameters are. Now we can go play on the field.
Yeah. Now it's exciting because really this is the big rule. And I think this prohibited transaction rule is the number one rule. As a lawyer that's advised clients, Mark and I have both done 10,000 consults with clients that want to use an IRA to go buy real estate or some other alternative asset. 90% of what you can't do comes down to that prohibited transaction rule we've been talking about. But that's it. That's it. So if you're like, I just want to make a great investment and invest in assets I believe in and use my retirement account. There's $40 trillion in U.S. retirement accounts. I want to take my little sliver of it and grow it to be as big as possible. You have a ton of opportunity. You just need to know a little bit, okay? And once you learn that a little bit, it's the same thing over and over again. Now, we're going to teach a lot more strategies on how to use an LLC. Like Mark said, how to partner with other people. These could even be some of these disqualified people, your spouse or your kids. How do I partner with them? What are some of the tax things I need to know? Make sure I avoid some of these tax issues that can sometimes come up. So we're going to be covering that in the future episodes. So make sure you're subscribed to the podcast and following us. We're going to be providing lots of updates.
Yep. Thanks everyone for listening. And also don't forget, give us a little 5-star, 2 thumbs up, 10 out of 10, 5 out of 5, whatever the hell. And spread the good word. Help us change the world. Thanks everybody. And we'll see you next week.